Good afternoon, Mr. Ryan. How are you today, sir?
I'm good, man. Happy almost holiday, almost Christmas,
Yeah, week from today, Christmas.
December 2020. It's here.
Yeah, way earlier than expected. We thought this
Yeah,
year has taken forever, but it has also gone by super quickly.
yeah, yeah. It's
Awesome.
definitely flown by.
Yep, and we took a few weeks off because this year has been crazy for sure. Man, I think all of 2020 has felt like what we call month end, right? And
Yeah,
coming into December, like it's worse because everyone's trying to beat the holidays and the year. So,
yep,
but
yeah. A lot of congestion, a lot of traffic on the freeway is what we kind of call it in our business. So,
for sure. All right, so for today, we were talking earlier, thought it would be a good idea to discuss financial planning for people who want to buy homes in the new year. And, now is the time to, earlier was the time to get ahead of that, but now is as good a time of any to start and not wait until they're ready to do it, especially with a lot of the challenges we're facing in the market today.
yep.
Um, One easy thing that I know that we could talk about every single year with this is people putting Christmas on credit cards, right? And getting that holiday hangover with debt and needing to make those payments in order to get their debt to income down or pay off those cards and things like that, and how it impacts um their down payment situation in the new year. So, what advice do you have around that?
So we always see whatever we do work wise on our credit in December shows up in our credit profile in January. And it really has to do with, we talked about this several calls ago, but it has to do with what your balance is at the time of reporting to the credit bureau. And so we don't always know when they're going to report, but a good indicator is when they release the statement. So if your statement on your credit card is due, it comes out on the 5th typically. You want to have that balance paid down as low as you can, off if possible, but as low as you can around the 3rd or 4th. That way, whenever they do report to the credit bureaus, they're reporting that lower balance. So it's okay to put things on credit, and there's specials. There's 0% for X amount of months and things like
Yep.
that. People take advantage of that. Then if you're going to go into a credit required situation like pre-approving for a house or maybe even refinancing or buying a car where you kind of want to maximize your scores,
Yeah.
it's always a good idea to do that early prep at least about a month in advance, just to make sure that whatever's showing up on the credit it's you're showing up in your best light. It's your best possible self, right, from a credit
Yes.
standpoint. So that's a good tip if you're throwing it on credit and you kind of are carrying a bigger balance than normal, but you're used to just paying it off anyways. Just we're kind of using it for points. Some people do that. Then
Mhm.
just make sure that you're paying it off before it actually reports,
Yeah.
and you won't notice any bit of an impact at all. But we do see people that do carry that balance and then they kind of wait. So the typical thing is stack in November and December. So the credit card starts to get a little heavy. It's going to show that heavy balance in January and February. And then hopefully the tax refund comes in February or March, and then you can pay it all back off. And
Yep.
that's a practice that a lot of people do. And it works, but the only negative is that if your score profile is impacted because you've now leveraged the credit card or maybe even opened some new credit cards, because when you went to check out,
Mhm.
they said, do you want to save 10, 20% today on your purchase? Like, get this card. People do it. And then guess what? You're going to put as much as you can on there. And so you can sometimes swing your credit 30, 40, 50 points. And that could be the difference between qualifying for the program you really are trying to seek
Mhm.
and not. So just something to be aware of, in your own, everybody knows, hey, I think I'm going to buy in January. I think I'm prepping for February or something like that. If you know that, at least you kind of know how to manage that, before it becomes a problem. Because right in that moment, what we
Mhm.
get is we get a call sometime mid-January and somebody says, it's 5 o'clock Friday night. I saw this house. I want to write an offer on it. There's 5 offers just came out. This house has been on the market for an hour.
Yep.
We don't have a whole lot of time to make you look better on paper. Like, we kind of are dealing with whatever we got. So if you can do some legwork ahead of time and prep, much better situation.
For sure. I want to touch on what you said with tax returns because a lot of people do use tax returns to pay off any debt that they accumulated through the holidays. But a lot of people also use their tax returns for down payment and closing costs on their loan.
Mhm.
And we know how quickly the government moves in the normal world. Um, so now with COVID, um, I think that, do you think it'd be a good idea for people to maybe try to file their taxes as early as they can in the year in hopes of getting that back sooner? Um, any tips around
Yeah,
that?
I think so. The only thing we've experienced from a tax standpoint in the quote unquote COVID environment has been any of the extensions that were done and validations on people's doing their extensions. So
Mm-hmm.
those are more of the late filers. Maybe even the end of, I think this year it was like end of, or the April 15th was pushed out, till like, I think June something.
Yeah.
So they gave some grace period in there. But we also know that some of those offices, were impacted on the amount of employees that they had on staff at any given moment. They were working with kind of a skeleton crew of people. And so knowing that we have had just really kind of an interesting year from an income standpoint for a lot of families, I would
Yeah.
imagine that the tax filing is pretty heavy in the early stages. So it's probably good again to get in line and just make sure if you're anticipating a refund, probably get your ducks in a row and get that stuff in early so you can try to get that money as soon as possible. Um, One other thing to kind of think about is the impact that this year, from an income standpoint, has had on somebody's taxes too. So it's another thing we could talk about if you want to go there.
Yeah.
Uh, but we have different tax brackets, and so depending on where you're at, you're going to fall into those various tax brackets. And so if you're used to making $80,000 a year, for example,
Mm-hmm.
but this year you made 30, you you could have been taxed at a very different rate. And so those are really important things to talk about with people. A lot of people use TurboTax and things. I think a good tax preparer is probably a good idea to reach out to and see, am I going to get a bigger refund or not? Or because my income dipped a little bit this year, is it going to place me into a different bracket? So that we can kind of
Mm-hmm.
consider those things. So those are good things that you just otherwise wouldn't think about.
Yeah, well, and another thing with that would be, for self-employed people like us, if your income took a hit this year, and you have to average your last 2 years worth of income, or not, so if that is the case and their income did take a hit in 2020, it would probably be in their best interest to purchase as early in 21 as possible so that they don't have to have 2020 filed if their income was less. Or does that still come up because it was 2020? Like, are they still super stringent on that?
So that's a great question, actually, that I would imagine we're going to talk about a lot as we enter into this next year.
Yes.
So somebody who's self-employed, the way that it would work today is we're going to take their last 2 years' taxes. In most cases, there are some exceptions where we just look at 1 year, but for the most part, we're going to look at 2018, 2019 right now. We're going to look at the year-to-date profit and loss, which is
Mm-hmm.
self-prepared. So somebody who's self-employed could just simply print out QuickBooks and go, "This is what I made this year. This is my expenses."
Yep.
But on top of that, we're also looking at the last 2 months bank statements, and we're using that to determine that there's activity and consistency within that business model.
Mm-hmm.
So when you're talking about like, hey, maybe file or don't file or buy early and not buy, the question becomes, what did 2020 kind of look like? We haven't gotten any revised guidance. So maybe 2020 was off, but maybe your business is kind of coming back online now.
Mm-hmm.
You might actually, once it's back online in that moment while things are looking pretty good, we don't get some kind of a weird shutdown that kind of puts you back on your heels again. If you had to make a move, that would be a good time, because that's the window of opportunity that we're looking at, or that banks are looking at, to say, hey, this business is working. It's okay. And there is some flexibility. I mean, we know that not every business is thriving this year. So we do know, and we have flexibility built in the guidelines,
Mm-hmm.
but only to a certain extent. They're not going to take, if a business has been out almost the whole year, we can't go off of like the last couple of years, because moving forward, is that even a viable business anymore or not? Or is the restaurant still open? Is the clothing store, that somebody owns is still even open or functional. We don't know.
Yeah,
So
for
the
sure.
underwriting guidelines are the way that they're in right now. It works, and we have to kind of plan with what we can see. And there could be some revisions to that down the road, but right now that's kind of what they're looking at. So I would say the window for somebody would be when you can validate what is going on in your business.
Mhm.
You want to strike while the iron's hot, because if you wait too long and it's like, oh well, 2 months ago my business was doing good, but this month it's not very good.
Yeah,
Unfortunately, you're not going to get a loan because they need to make sure that you still have consistent active business.
yeah, for sure. And so another thing that I thought of while you were talking is, self-employed businesses. Yeah, you have to be doing fine, but what about the PPP loans? And what a lot of people are calling the surprise cost of those, the
Right.
37% tax. Um, should we just mum's the word on that and not draw any
Right.
attention to that? Like, our underwriters, do you think, because we haven't hit that yet, because it won't be due until next year, how big of a deal do you think verification of that is going to be for self-employed business owners next year?
Yeah, I mean, at the moment, the taxes aren't really coming into play on that PPP money, the payback of the PPP money.
Yeah.
It's more, are we factoring in or actually backing out the PPP funds? So if you got $50,000 in PPP funds
Mm-hmm.
and you get a P&L over to us and you kind of built in as a business owner, you built in the 50K into the profit,
Mm-hmm.
we're going to pull that back out. It's not profit. It's really there to kind of design to, it's a debt. It's there to kind of help float your business. So the emergency funds, anything in that space, and they can see it too, by the way. You can see it on a lot of times on the business owner's credit report. It'll
Mm-hmm.
show the inquiry from, it's like a federal inquiry that shows up there.
Yeah.
And then there's a few things behind the scenes that would tell us or indicate to an underwriter that, hey, these funds were actually received. Ask some additional questions and get some more paperwork on it.
So there's no hiding that, even though we haven't filed taxes yet and don't have to pay that fee yet.
There's no hiding it. And there are some businesses, I've had applications where they got the PPP and they're trying to use that money to close. You can't buy a
Mhm.
house with that PPP money. It's just not going to work out.
Yeah, I remember a few calls ago we talked about that as well. Um, okay, so and then now let's go back to timing with end of year and purchase and all of that. Like with the tax returns and the government possibly being slow. Um, a topic that is one of those words for 2020 is forbearance. Um, this is going on a lot longer. Like we haven't seen any major repercussions yet as far as like foreclosure activity on that stuff goes. But in the spirit of financial planning for next year, and if they're going to sell and purchase, um, what are you seeing now, or what are we expecting to see with regards to people purchasing and having been in forbearance?
Yeah, so the forbearance topic is really interesting. I'll give you a couple of examples and we can kind of draw from that. So let's say you're buying a house and you have other houses that you already own, and one or two of those are in forbearance. Like maybe your rental property or tenant's not paying, so you threw that in forbearance
Mhm.
and it's not out. It's going to impact your new purchase. You cannot have a loan in forbearance and do your purchase. Now you can close on that. Like let's say that property was up for sale and it closed. As long as it got paid back in its entirety,
Mm-hmm.
you're good. You can move forward. You're fine. But you can't have it outstanding. So you're going to have to get current on that. Now, if you, let's say you were in forbearance in April and you haven't made a payment, you got an extension on it, you're still in forbearance now. We could, we could get some kind of a modification together. We're seeing those now where the banks are going, all right, doesn't look like you're out of the woods. Let's do a modification. They'll do that. And on the refinance front and on a new purchase front, there's no penalty for taking that. There's no late. It's not like a negative amount. It's kind of like a disaster relief kind of thing.
Yeah.
That money usually is put on the back end and you still owe it. And if that's the case, like let's say that you didn't bring all those payments current, like you owe $28,000 in payments you haven't made all year. That
Mhm.
happens, right? So sometimes people go, oh, if you're going to buy or refi, you got to bring all that 28 grand back. No, that's not the case. They're going to put that on the back end of the loan. And then you're going to need to make a couple of payments toward that. You just want to make sure that now you're making kind of a consistent, after that agreement's in place, now you've made a couple of payments on time, you're good. Usually the answer is 3. There are some variations from bank to bank and program to program. But usually after that modification or whatever agreement you have, you need to have
Mhm.
3 payments made, and then you're okay. But
Okay.
that money, you don't have to. Originally, we thought like these people are going to have to bring in a chunk of money. Like at the end of the 4th month, right? They're going to miss. You got to bring all 4 payments.
Mhm.
It's not necessarily the case. You actually are credit worthy right after that, even if they roll that money back.
Yeah. And I mean, it's not all sunshine and rainbows with that, because their loan payoff amount will be slightly higher because they weren't on schedule with their monthly payments, right? And so their interest wasn't getting paid, and so it'll compound a little bit more, right? Have you
It
seen
could be.
any of that yet? And I mean, it's not
We
a
have, yeah,
huge.
we've seen statements that are the exact same payment. We've even seen statements where they lower things down a little bit,
Mhm.
and just that money kind of gets thrown in the back end. And it's not a guaranteed thing, so you have to talk to your servicer. If you're in forbearance, communication is key. And what we have heard is people go, well, I tried to call my servicer, but I was on hold for 2.5 hours and I just gave up.
Yeah.
You need to be on hold for 3 hours, 4 hours. I don't care how long it takes. You need to talk to them, because if you
Mhm.
don't talk to them and you don't understand what they're going to put you in or how they're going to remedy whatever situation you're in, you could be in for kind of a bad surprise. Because we've seen that too, where people are like, I don't know what this money is. You go, are you in forbearance? And they're like, oh yeah, I was. I guess I do owe that. They had no clue. They just didn't know how it worked.
Yeah. Well, and nobody did. Like, that's not a fault, right? But
Not at
we're
all.
all experiencing it now.
Yeah, it's a brand
Um,
new thing.
yeah. And then so same thing with that on the, get after it early and get in line. Um, I'm sure there's a lot of people who, might be planning on moving at the beginning of the year. And if they were in forbearance and they all have the same bank as you, and they're all calling in January, February, March, might behoove you to be making those phone calls right now, even though it does involve sitting on hold forever,
Right.
because they're running skeleton crews. But as the call influx goes up at the beginning of the year, if they're still running a skeleton crew, it's just going to be more painful.
Yep. Yeah, and being last minute on that stuff, I think is really just kind of a bad choice. Right now you have plenty of time to kind of get ahead of that, get that conversation started. If you don't think you're going to be able to bring all those payments current, you got to talk to these guys, because at the end of that 12, you can do these extensions out all the way up to 12 months, but at the end of that 12 months, you're not extending that anymore. So now you're going to have mortgage lates. Up
Yeah.
until that 12-month mark, you're not going to have any lates. They're going to work with you in some fashion.
Mm-hmm.
But after that, these are mortgage lates. And if you're still not on track, now you're going to be into like a real loan modification, which we remember back from 2007 and 8 and all that. Those were
Yes.
kind of a mess. So, get ahead of that stuff so you don't have this massive problem. And at the end of the day, like if you don't think you're going to be able to make that payment and you work out an agreement with them and you're like, that's still not going to work for me, you've got equity in your house. I mean,
Yeah.
house prices have gone up how much this year? I mean, just I saw like
The average selling price went up almost $100,000 from January through the end of November. And now that's the average selling price. So maybe not all homes increased $100,000 in value,
right,
but that is it was over 20%. And we've never had that kind of growth since 2000 at least.
yeah,
2012 or 13, one of those years, we had like a 12, no, like a 15 or 16% growth, which was massive. But
it's
this year
huge.
we've had more than 20%. It's so even if you bought at the beginning of the year or a few months ago, you could still, and if you did 3.5 down, you did minimum payments, you could possibly still sell and at least break even, just
Right.
because the way the market has gone.
Yeah, I mean, I've seen some stats. They're more nationalized or not like local, but I've seen stats where it's like, hey, there's 8% growth. This
Mm-hmm.
is this year and 6 last year, and start adding that up, and you're like, man, somebody had their down payment for one, plus then you have these extra, growth measures that they've received over the last couple of years. So it would suck. You wanted to buy a house, and your intent was to stay in there forever, but life kind of takes some weird turns sometimes. You got to get out if you have to get out. But if not, and you can work out some kind of agreement with the bank, then I mean, stay by all means. And they're being really, really flexible right now. So this is the time to kind of take action. Make sure you know what all your options are, so you can play, your hand, right? So you can play the
Yeah,
right hand, see what cards you have. So
for sure. And again, like we want to have all of that stuff done prior to entering into a contract. Um,
yes.
as a buyer, like you do not want, like it's hard enough right now to get your offer accepted and get into escrow. But if you had to be asking for extensions because of something like this on your credit that you didn't take care of going in beforehand, because we are seeing multiple offers and strong offers, with large down payments, waiving appraisal, waiving inspection, things like that, a seller will cancel you super quick before they would grant you an extension, especially over something like this that may feel like it's out of your control right now, but you should have planned ahead. Like a seller does not, they're just as anxious as any buyer to sell. And if there's something gets drug out like this, the buyer in this case, if the seller cancels due to non-performance, the buyer's going to be out there inspection and their appraisal. That's going to be, $1,000 out of pocket that they don't get back.
Yeah.
And hopefully they didn't remove their contingencies and lose that, earnest money deposit as well. So
Yeah, you got to
really need to
watch.
get ahead of this.
So watch credit. If you're in a forbearance situation, watch your credit. Do Credit Karma or something like that. So you can have some eyes on it. We did have a client recently who was in forbearance on a house that they were selling and sold the house, paid off the forbearance. So everything's good, right? Everybody got paid. Bank got all the money that they were owed. Everything's okay. Took a couple months off to kind of like save up a little bit more money and then go buy another home. And through that process, got two mortgage rates.
Hmm.
It's like, hey, do you know you have two mortgage rates? Like, no, I was in forbearance. Like, there shouldn't be any mortgage rates. Yeah. So they had to call into the servicer. Guess what? The servicer's like, oh yeah, that was a mistake. We'll fix that. Right. Give us a letter. Well, we can't. Why? Oh, that department's kind of like slow right now. It's going to be 3 weeks. Well, they're in escrow on a house. They don't have 3 weeks. They're closing in 3 weeks.
Yeah.
Toast. Got to back out of that deal.
And
And
again,
it's
like if
no
they're,
fault of the client. It's just you got to monitor that stuff. Just so if you do see in the instance, and we've seen it on credit cards too, not just on the mortgage. We've seen it where I call up a credit card company and go, hey, I'm a little shy this month. They go, no problem. We'll give you a few months, there's kind of like a forbearance thing for credit cards. See people do that and then they get a late and they just don't understand the mechanics, like how to get back online.
mm-hmm.
And some of those lights are valid and some of them aren't. So you got to understand like how that all works. Again, it's all down to communication with your lender, whether it be credit card, student loan, an auto loan, any of that stuff that you're kind of working out. You got to have those conversations, right? To understand what your options are.
For sure. And ahead of time.
And ahead of time.
Awesome. All right.
And what was I going to tell you? So 2021,
mm-hmm.
tons and tons and tons of foreclosures, right?
0. So NAR had said something to the effect, it's been a few weeks now, said something to the effect of the chances of us facing another foreclosure crisis are next to 0. And they said that super recently in the middle of COVID and forbearance and all of those things. And I've had that conversation with a lot of people, and it's just that game has changed so much since the last cycle. In 2008, 9, 10, through that whole big dip, a lot of the hedge fund groups were not involved in real estate. And then you remember like 11, 12, 13, like they came in and some huge companies like American Homes for Rent, like they came in and they created these portfolios and now they're on Wall Street and with that as an asset. That didn't exist last time. And so when you've got huge companies like that were snapping up homes, I think that largely has a lot to do with why we won't see it happen again. It just won't.
Yeah, well,
the bank won't foreclose and take the house back. That house will sell, whether the bank sells it as a non-performing asset on the back end before even doing the foreclosure process, or if it does go through the process and goes to auction, it'll get snapped up.
yeah, we'll do another call on that so we can really dive in to really kind of break out so that, because what I hear sometimes is hey, I'm going to wait 6 months because there's going to have, it's not the case. Like, there's no possible way there would be, there's not even that many in the queue. And we can talk a little bit more about how long it takes for one of those to come through. But if it was essentially going into foreclosure today, it's not even able to be purchased for, like, the average is like 800 days. You're talking almost 3 years from now before somebody can physically buy it on the secondary market as a foreclosure.
Yeah,
Um,
it's
and on
obnoxious.
top of that, you have tons and tons of backstops that are in place and equity, right? And the list goes on and on. There's a bunch of other options before you even get to that nasty spot. So, um,
So one thing to touch on real quick with that, because I
yeah,
think that maybe why that is such a popular conversation outside of people hoping the market crashes for financial gain,
right.
is I think that on like Zillow, there's a lot of properties that are showing pre foreclosure. And what people don't understand is that just means that that person has missed a payment. Doesn't even mean that the bank has started the foreclosure process. So, very
Mhm.
likely, any home in forbearance that has chosen to also miss the payment is showing up there. But like we said, you can easily get a 12-month extension on just forbearance before they start the foreclosure process, and then starts, the regular process. And if the courts are open, like we can hit on that another day. But I think
Yeah,
that has become so popular because of things like Zillow showing pre foreclosures and those being homes that are just in forbearance.
yeah,
So,
that's a big deal. You want me to give you just a quick, like 30-second on rates?
yeah.
Everybody kind of wants to know about
How many
rates.
historic lows have we hit this year? It's like
Yeah,
14.
yeah, it's like every time we come on, hey, these are historic lows, and then they hit another tier and another tier and another tier.
Mm-hmm.
So they are at historic lows again, the new historic low. And it was, I think, Wednesday of this week, the Fed said, look, we're going to keep rates low through 2023. So they gave an announcement about keeping the Fed funds rate at zero. So what does that mean for us as consumers? Are we getting these low rates for the next several years? Well, you can look back and you can see, like, when rates dip down on the Fed funds level, there have been times where interest rates, mortgage rates, are up, and there's also times where they dip. They also, on top of that, announced $80 billion in assistance to buy mortgage-backed securities on a monthly basis, and they're continuing that right now through 2023. So that means for us that rates should stay low. There's really nothing that's triggering that. What they're trying to do is trying to kind of like stir up inflation. It's not quite happening at the level that they're looking for. And so because of that, rates should remain low. Now, I'll caution people, there's going to be these little tiny peaks where they go up a little bit and that they will probably drop back down. How long it takes for that cycle to happen is really hard to tell. So it could go up, like in the middle of a purchase, goes up 0.5%. And it's like, oh my gosh, they're spiking now. It could take it 2 months before they come back down, but they might come back down.
Yeah.
Um, so the good thing is, if you're in the middle of like a purchase, is to try to take what's on the table and lock. And like, it's so easy as rates are falling to say, I'm going to wait till next week because I think they're getting a bit better. And we see that sometimes with some of the most ridiculous rates ever. And the conversation sometimes drives me nuts because I can see the analytics and I'm like, why? Like, you're picking up an extra eighth, maybe, but you're risking like maybe 3/8 on your rate. I don't understand the logic behind it.
Yeah.
It's funny the way it works when it's going down. So as rates are dropping, we have people that are going, okay, I'm getting offered 2.75, and I'm going to wait till it hits to 2.26 or to 2.5 without having to pay the points to get to 2.5. Okay. When it goes up, it's the other way. It's hey, what's the rate? Oh, the rate, moved from 2.75 to 3. Like, okay, I'm gonna wait and see if it goes down. Like, and then it's the next day. What did it go to? Now it's 3.125. Oh, and then the next day, 3.25. So when it moves up, sometimes it moves fast. And then those calls, and then what happens is they end up locking in like 3.5 instead of 2.75 because they're like, oh, I got to stop the bleeding somewhere. I just got to lock it and be done with it because it has no end in sight. It just keeps going up and up and up.
Yeah.
So when we talk about rate lock and that kind of thing, a lot of times, yeah, if we see that there's a good indicator, rates are going to get a lot better, let people know that, and we'll just kind of float. If not, if it's what you have and you can afford it and it looks good, I mean, you're never going to complain in 10 years from now. You're not going to be like, you know what, I got 2.75 in my loan. I should have got 2.6.
Yeah.
You won't be worried about that. You'll be thankful that you got 2.6, 2.5, 2.6, whatever the rate would be.
Yeah.
Be very grateful for that. And we're seeing people save an absolute boatload of money right now, not only on the refinance front, which is really popular. People are consolidating debts. I mean, we're doing cash out consolidations in the upper twos. I mean, that's crazy. You're taking all of the debt, putting it into one place and just making one new payment. We took somebody the other day who was on pace to pay everything off in like 18 years and dropped it down to 9, and they're not making any more money out of pocket. They're sending the same amount of money every month. They're just doing it at a cheaper rate.
Yeah.
But we're seeing it on purchase too. Like some of the purchases that are being made in these really, really low rate environments, if you figure out like, hey, that's my housing cost and I'm fixing that. And I'm fixing that for not only today, I'm fixing that for tomorrow, for 5 years, for 10, for 20, for 30 years, however long you want to stay there, that housing cost is remaining in that place. That's insane. Because if you look back 10 years ago and you find out like what were rents going for, they were a heck of a lot cheaper than they are today.
Oh yeah.
So that waiting game sometimes really bites you in the butt when things kind of start to move up. Guess what's going to move up is we have more and more demand for housing. Rents are going to continue to climb. They're not dropping it anytime soon. There's nobody that I've talked to that's like, you know what, I was thinking about lowering the rents on all my tenants. I never have heard that conversation.
Said no landlord ever.
Yeah, they don't do it. They're like, yeah, I don't want to be rude. I don't want to be mean, but I'm under market by like $600 a month right now. Like, what should I do? That's the conversation that I get all the time. Mm-hmm. So
one thing real quick on rates, I haven't noticed, and you see this on the back end, obviously. We're in December, and the fee increase that we were going to be seeing on loans, how is that looking? Because it looked like in November, the average points for a loan were down. I think it was back down to 0.6. It's been a few months at 0.7.
Yeah, so they didn't slow things down. That money grab, that kind of like semi-criminal money grab from Fannie Mae and Freddie Mac on that.
Yep.
It went through. Everybody's paying it now. It's a half point. Doesn't mean that you're going to pay a half point on your loan, but what happens is in the banking world, there's adjusters, and so that half a point is just a simple adjustment on the back end. And so, just like if you had the less than perfect credit score, you may see a quarter, or 3/8, or a half adjustment. You're going to see the same thing on the refi. And so the rate offered may be just a tick higher because we're building in those extra adjustments. So that extra half a point we're talking about is built into usually the street price, or the price that you see as a consumer. So not everybody's really paying it. You could say, I'm going to pay, what's the rate with a half a point, and it might move it down 1/8%, but most of the time just absorb it in the rate cost and then go, all right, so instead of offering somebody 2.5% for a rate, they're going to offer them like 2.625 and bury that extra half so you don't have to pay it out of pocket. That's kind of how that works. So that's why you're not seeing the movement. Like if you see the average rates that are announced from Fannie Mae and Freddie Mac, and you're not seeing the points tick up, it's just because of that. So it's reflected in the average rate.
Okay, that makes sense, because I remember thinking before that they were gonna use the cost of the loan up front to offset any profit, from the long term on interest rates, but we haven't really seen that. But like you said, it's being built into the offered rate. So,
and if anything, the refinance activities probably ticked up since that fee kind of got thrown in there. I don't know if it's just the fact that there's a buzzword about, hey, rates are going to get higher, more expensive, so everybody kind of got off the fence. But we definitely have seen, and that's just not us, it's across the board, we've seen a lot of people in that same position where they got more applications now than they did before.
Yeah. Crazy.
Yeah.
And it doesn't look like it's slowing down. So.
No, but I mean, really, really good opportunities. I mean, that's what I get. I know that excites you, it excites me, and we're talking to somebody about maybe selling a place that they bought several years ago, moving into a dream home. It's a really, really fun conversation now because we're talking about price points that they otherwise wouldn't have talked about, and the type of house that they can get. Yeah, they're it's up, right? Price is
Yeah.
up, but the cost for that house is cheaper than when the price was down.
Yep.
So, and that's what you're really locking in over time is you're locking in how much am I paying for this place. It's
The
not just the
affordability.
acquisition. You got to look at how much you pay back in interest too. So,
Mhm.
when you look at that long-term play, some people are getting some killer deals on this stuff. It's great.
For sure. And then like with with rents being so high right now, still and continuing,
Yeah.
um, the people that like, hey, I'm going to sell and see if the market corrects. I'll rent for a year. Man, at 2000 and 2000 is cheap rent right now. But at 2000, it's 24,000 in the year. That's 5, 6, 7% of the average sales price. And yeah, you might win that game if the market corrected 10% over the next 12 months. But if it doesn't, you lost. And your cost on the back end is going to be even higher.
Right.
So
So you mentioned like, yeah, let's look hypothetical. There's no data to say it would correct by 10, but if it corrected by 10, so what is that? You just wiped out 2020's appreciation model and then you got it maybe a percent reduction on 2019.
yeah,
It's not setting you back that far. It's not taking us back to 2010 or 12 or anything like that. That's the thing that I think people you hear pullback or reduction, and I think you go back in time, like Marty McFly, like you go back like a
yeah,
decade, and you're like, oh yeah, it's going to be this price. It's not the case.
yeah. We don't have adjustable rate mortgages. We don't have 80/20s running rampant. We don't.
Right.
They actually make sure that you have a job and that you're making the money you say, and it's not just can you fog a mirror. So
I had a client that messaged me yesterday that they haven't made a payment since March.
mhm.
And they're in a bad spot. Just had a really hard time, and they're worried. They're like, what do we do? Do we modify this place? Like our house has gone up, and they can walk away. They did a VA 100% finance. They had no money into this house other than their payments.
Mhm.
And right now they could sell it and walk away with about 15 to 20 grand in their pocket. And they're like, I don't know, but we can't make our mortgage payment. We know that. We know we're not going to be able to make it in like 6 months either. It's like, dude, put the 15K in your pocket. Like you need that right now. Like that's a gift. You
Yeah,
got lucky because the other way around is if none of this assistance was there, none of this the CARES Act didn't really like cover you, so you didn't have a mortgage rate. You'd have like destroyed credit right now
yeah,
and a foreclosure possibly on your hands, and you wouldn't have any of that money. And so they had to look at it in a different, like they were looking at it as like, hey, we're losing our house. They're looking at now like we're gaining a good opportunity here. Like we got a little bit of a gift. Let's take it. We got a life raft that we can hang on to.
yeah.
Our ship is sinking, and it's facing the facts for them. And it was cool that in their position, I mean, they really are in a bad spot. Just got kind of hit hard with this whole thing,
Mhm.
but they can still kind of come out a little bit better than they otherwise would have. So it's neat to see that success. Like they're not going to get destroyed through this whole thing. So it's
Yeah.
good.
Well, even if they don't keep any of that 15, 20 grand, like we just said, that could pay their rent for the next year. Like,
Exactly.
hey, you didn't lose anything. Your credit didn't get destroyed and you got free rent for a year. Like, yeah, you should probably make that move and get back on your feet.
Right.
And then one more thing, you said that they were VA. What happens when a VA forecloses and how does that affect differently moving forward?
It's about the same, but what happens is you have a like a ding against your VA, so you have your VA entitlement,
Mhm.
and so then you to use the VA in the future, you can even with a foreclosure, you can, but if that ding against your entitlement is too heavy, it may limit how much VA loan you can handle in the future and get approved for, unless you pay back. Like I've had loans where at a foreclosure 15 years ago, and
Mhm.
the VA is like, hey, you're welcome to come back here. You're a vet. We'll do a loan for you. However, you owe us 28 grand from that foreclosure 15 years ago. So if you pay that back, we'll give you the whole entitlement. You do 100% financing, but if you don't, well, we're only going to guarantee, a $60,000 loan for you. So sometimes there's an impact there. Other
Yeah.
than that, from a credit standpoint, all the mechanics behind it's exactly the same.
Yeah. No, that's what I was going for.
Yeah,
Um, all right. I got to get going. I have another appointment at
perfect.
3 that I need to get ready for. But thank you for joining us again today. You guys, if you have any questions about any of the financial planning stuff moving forward into the year, obviously reach out to one or both of us, and we would be happy to answer any questions you have. And if you are in forbearance and you plan on making any kind of move, call one of us and let's talk that through so you can be in a position to make that move next year. And anything else comes up, feel free to reach out to us.
Perfect.
All right, take
All
care,
right.
Ryan.
Thanks, guys.
Bye.